Hello, and welcome to Crescent Private Wealth's August 2025 market update. My name is Omar Basal. Let's jump right in. We're going to discuss economic news of the last month, followed by a discussion about interest rates. We'll make it a little bit more exciting than the topic normally is. We'll discuss stocks and what's been driving their performance recently, commodities, and finally we'll wrap up with crypto. So, with respect to economic news, the most significant item of the last month was the jobs report for the month of July. It showed that the number of new jobs created in the US was 73,000, which was well below expectations. And more importantly, the jobs report numbers for May and June were revised lower by about 258,000. So, what you should understand is that the government estimate the number of new jobs created using a survey, and as they get more responses from that survey, they get better, more accurate forecasts. And the data for May and June was preliminary, but in August they had much better data, and they had to revise the number, those numbers lower. Now, the response from the president on the negative news, on the negative revisions of the jobs numbers, was to fire the head of the Bureau of Labor Statistics and appoint a new person, which frankly we see that commonly in emerging markets, third world countries, uncommon in developed markets, because it causes investors to lose confidence in the numbers when a person seems to be fired, not because of any problems in the data quality or data gathering, but because it seems the numbers were not positively received by the leadership of the country. So, revisions they happen all the time. This is not something new. Investors are well aware of them, but what is new is a person being fired because the revisions were large. Now, the 3-month average job gains in the US fell to 35,000. So just to give you an idea, that's the lowest number since 2010. If you exclude a couple of months of COVID, which was an outlier, but excluding that 2020 COVID situation, the average number of 3-month average job gains is now 35,000, which is the lowest since 2010. Consumer inflation is running about 3%. Wholesale inflation, which is at the company's level, is also running pretty high, or around 3% as well. And you should expect that inflation level, the wholesale inflation, is going to be impacted by the tariffs. Some of the cost of the tariffs will be passed through to consumers, but some of the cost of the tariffs will be hit by the companies, basically having lower profits. So this chart just shows you the number of new jobs created in the US by month from 2021 through month of July. And you can see, and the solid line is the 3-month average, and the bars are the individual months. So the 2021 numbers are abnormally high because so many jobs were lost in 2020 as a result of COVID. And then in 2021, as the economy started to recover, you started to see those jobs just simply be gained back. So you shouldn't, that's not a normal level of job growth per month, but you can see that the 2022, 2023 levels are meaningfully higher than where we are today. We're now sitting at about 35,000 3-month average for new jobs, which is indicative of a slowing economy. Does it mean there's a recession? Not yet. We don't know for sure, but it certainly is, I would say, like a yellow kind of warning sign. Let's look at interest rates. So the weak jobs report number prompted the Fed chair, Jerome Powell, to signal a cut in interest rates. So currently the short-term interest rates are between 4.25% and 4.5%. They've been there the whole year, but the Fed chair is but giving indications that they're probably going to be cut in September. And that potentially would bring it down from, say, 4.25% to 4.5% to the range of 4% to 4.25%. That's the expectation of the market. Now, President Trump is putting tremendous pressure on the Fed to lower interest rates more. Obviously, he would benefit politically if interest rates were 0%. If you think about it, that would spur a lot more spending. It would spur home price appreciation. It would spur a lot of things. But the reason the Fed doesn't do that is because they have to think about inflation. And if they cut interest rates to 0%, they're going to spur inflation, which is going to make matters actually worse. But despite that, the president's putting pressure. At first he was going to fire the Fed chair, Jerome Powell, but he backed off that because the Jerome Powell's term ends in May of next year. But he has fired Lisa Cook, a Federal Reserve governor. She's fighting that. The reason given was some mortgage application listing 2 principal residences as opposed to 1. Or applying for a mortgage, I should say, and one mortgage saying, this is my principal residence, and another mortgage application for a different home putting this is my principal residence. So you can, to have it, spending more majority of your time in 2 houses does not make sense. But at the same time, no president has ever fired anyone from the Fed ever since the creation of the Fed. So this will go to court, but it certainly puts the idea in investors' minds that, okay, the central bank is not going to really be independent like it is independent in Canada or Europe or Japan or pretty much everywhere else, except in third world countries. There is a lot more political pressure. We see that very commonly, and as a result, you see currencies simply weaken. Right, so there's a reason that the Turkish lira is a weak currency and has lost so much of its value. Part of the reason is that there's not really an independence of the central bank. When many years ago, the global economy was actually on the gold standard, where currencies were tied to gold, and there wasn't any weakness in currencies, frankly. But that's not the reality today. Today, most currencies are fiat or simply backed by nothing, backed by the government, and so you do get weakness over time as a result of inflation. And that's why there's this independence of the central bank, because they're trying to prevent that depreciation of that currency that could occur if a ruler decided to simply push interest rates to 0% to win elections. Long-term interest rates have also been falling given the weakening economic picture. I would just make a note here that if investors feel that the president is, controlling the central bank, then you might see long-term interest rates actually rise because they would simply be expecting higher inflation in the future. So that's something that could occur, but initially, at least, the long-term interest rates, like 10 year, 30 years, have been falling. This is a chart showing you the Federal Reserve rate, the Fed funds rate, and this goes back to 1950s, so you can get a real sense of the history here. You can see in the 1970s and early 80s, the federal funds rate was pushed up to around 18%, right? Why was it done that way? Because inflation was double digits. And so the Federal Reserve was trying to squash that inflation. The gentleman named Paul Volcker, who was the chairman, and eventually he did stop the inflation, but it forced the economy into a recession. So obviously a president would not do that if they controlled the central bank, because they would want to win the election. And if you force the economy to a recession, you're going to get voted out of office. You can see on the far right-hand chart, the interest rates were 0% for much of the 2010s, and then they picked up in the late 2010s, but then collapsed when COVID hit. Then after the inflation that we got in 2021 and 2022, you saw the Federal Reserve respond by raising interest rates, but now they've been cutting them, but they've been on pause for 5 meetings, but likely to cut next month in September. Let's look at stocks. So U.S. stocks have actually underperformed the global equity markets in 2025, but they're still at all-time new highs. The prospect of lower interest rates and enthusiasm around artificial intelligence has pushed stocks higher in the U.S. Historically, investors who bought stocks with valuations similar to today have actually not been richly rewarded. They've been hurt. So if you're thinking about buying stocks for 5-10 years, this is not a good time to be buying U.S. stocks. Much better to buy global stocks. But having said that, that's a longer-term relationship. In other words, the valuations give you great insights about long-term returns, but not necessarily short-term returns. And so in the short term, U.S. stocks could still rise, despite how expensive they are. This shows you that 9 stocks in the U.S. have generated about 60% of the returns in the market. So those companies are NVIDIA, Microsoft, Meta, Broadcom, Palantir, Netflix, Oracle, Alphabet and Amazon. Most of these are related to AI. And you can, just get a sense of how concentrated the returns have been. Will that continue? Very hard to say, but certainly it's not as healthy to see a market driven by just a couple of stocks. This shows you the valuation of the U.S. equity market, and so you can really see here that this takes you back to 95. You can see that in the 2000s there was that was the peak of the market, the tech bubble, and that was a really bad time to buy stocks. You can see in 2008 when the global financial crisis happened, valuations fell tremendously, and that was a great time to buy stocks, U.S. stocks. Today we're sitting at levels that have not been seen before. Frankly, that's the highest ever, at least on this valuation measure. And that should concern you if you're holding stocks for 5-10 years. Now, again, in the short term, the markets could rally because of the prospect of a cut of interest rates or because NVIDIA reports good earnings. But again, that's not, we don't invest for 1 month timeframes. We're investing for 5-10 year timeframes. And so you do not want to be positioned heavily in US stocks at these kind of valuation measures. You'd want to be buying them when they're much cheaper. Let's talk about commodities. So commodities are like energy commodities like oil and natural gas, or agricultural commodities like cotton, or precious metals like gold and silver, base metals like copper. These are different types of commodities that we use on a day-to-day basis. Commodities are very sensitive to economic growth, so they can be very good canaries in the coal mine, or they can give you really good sense of the health of an economy or global economy for that matter. Energy commodities like crude oil have been signaling overall weakness. However, we've been seeing good strength in precious metals, and that's probably related to the weakness of the dollar, which we'll discuss shortly. Well, we've already touched upon it. The attacks on the Fed, these things are causing concerns. The firing of the head of the Bureau of Labor Statistics, these things cause investors to worry because they lose confidence in the stability, the safety of the US dollar. So this shows you a chart of crude oil over a couple of years, and you can see how it's basically continued to move lower over time. Again, typically, if you had a really strong economy, you'd expect oil prices to be doing better. Obviously, the adoption of electric vehicles has reduced the demand for crude oil, but at the same time, it's still a primary energy input, and therefore its weakness is indicative of a weakening economy. Gold prices have just been on a tear, and it's being supported by central banks buying gold after they saw what happened with respect to Russia, assets being frozen by the U.S. government after it invaded Ukraine. So these were Russian dollars that were they were U.S. dollars that were owned by the Russian government legally. They weren't stolen, but after the invasion, the U.S. government said, we're going to freeze your dollars and not give them back to you. And that caused other countries to simply worry, okay, if we have a problem with the U.S., our money could also be frozen. Therefore, you've been seeing central banks buy gold as a way to diversify. Couple that with the attacks on the Federal Reserve, couple that with the firing of the head of the Bureau of Labor Statistics. All of those are simply more enforcing of a view of seeing the U.S. dollar as a risky currency to hold, or given that the central bank might not be independent, and therefore it might let inflation get out of control, given that you might start to doubt some of the data coming out if you know that a person who was overseeing the data was appointed to replace someone who was a technocrat or someone who people trusted to produce accurate data. So anyways, we can see here how much gold prices have benefited. Silver prices also have done very well, probably for the similar reasons as gold, though silver is used in more industrial activities. Finally, we'll discuss crypto. So last month, a new law was passed by Congress and signed into law by the president called the Genius Act, which outlines specifically the regulations around stable coins. These are cryptocurrencies tied to, like, for example, the dollar. So this has basically given banks and others more confidence to introduce stable coins and accommodate their use. The SEC, that's the Securities and Exchange Commission, the regulatory authority in the U.S., has been introducing regulatory reforms aimed at integrating crypto into capital markets. So what are the rules around custody of crypto assets, trading of crypto assets? Are crypto assets a security or not? So the SEC has been indicating that they are not a security, which basically means that they're less regulated. So if they were a security like a stock, there's a lot more red tape that goes around buying and selling them. Whereas if they're not a security, if they're considered what they call a digital asset, then potentially it's easier for firms to offer them. So again, confidence in the US dollar has been falling as a result of the aforementioned reasons, and therefore that's supporting crypto as well, because crypto does not have these problems. There's no, person deciding that the Bitcoin supply is going to be increasing by this much or that much. It's fixed. There's a formula, it's mathematical formulas, and therefore it is seen as a potential alternative to the dollar. And we've seen crypto assets increase as a result. This is the Ether, which is the cryptocurrency used in the Ethereum network. So the Genius Act I mentioned earlier that was signed into law is governing stablecoins. Stablecoins, again, are cryptocurrencies tied to the dollar or fiat currencies in general. And these stable coins are typically on the Ethereum network. Therefore, you see this increase in Ether prices because potentially you're going to start to see more stable coins being issued. And here's the dollar. You can see how poorly it's been doing. Again, the dollar has some challenges ahead of it, I believe, given that investors are seeing more risks holding U.S. assets, and the recent moves around the Federal Reserve are unprecedented, and never happened before in its history where a federal chairman or federal governor was being fired by a president. So we're kind of uncharted territory here about how let me be more specific. We're uncharted territory for the U.S. This is, again, common in third world countries where there isn't this independence, but what's also common in those countries is that currencies are very unreliable and weak. So potentially you could see, I think, more weakness in the U.S. dollar, and this will be beneficial to gold prices, crypto prices, and so forth. So thank you very much for taking the time. We'll wrap up with one or two legalese slides to make sure we cover that as well. But we do look forward to welcoming you next month for our next updates.